Hi, I'm going to get right to the news today, but first, go to my website and download a free copy of my book. It's the best-selling book on precious metals, and you can buy it on Amazon or you can get it here for free. Now, before I get into the news, very often I'll go down and scroll through go through these charts and talk about the gold-silver ratio and the prices and so on. One thing that I have never shown you before is that if you click on these links here, it'll drill down to more detailed charts that are more interactive. You can change the time frame on them here. You can compare them to different indices. You can do ratio charts. And so here's gold, and you see this sort of march up. Other than this bump here and this dip here, you could draw a pretty nice trend line over that thing. And it's just going up and up and up very, very nicely, very reliably. But this was the pullback just before the big mad rush into gold and silver. But what you see here is 1500s, a dip down into the high 14s, the 1600s, the 1700s, and then in just the past, this was the mid 1700s and low 1700s. And in just the past 2 weeks here, we've gone into the low 1800s. And you'll see later that there's some major banks now saying that record highs are almost inevitable for gold in short order here. Silver, when you look at this, you had 1850 back here in February, and it dropped all the way to 12. I wish I had more cash on the sidelines back then, because this is the gold-silver ratio, as you'll see in a minute. This is where the gold-silver ratio peaked at 122. But we go back into the 14s, 15s, and then up into the mid-17s. And then in just the past month, it has gone all the way up into the high 19s. And we're hanging out just below $20 now. So pretty impressive performance. And as far as the gold-silver ratio, what that translates to, when this is rising, gold is outperforming silver, or silver is falling faster than gold. That's what was happening here. Both of them fell, as you recall from those other charts. Hitting a peak of silver's value being 1/122nd of gold's value. In other words, it took 122 ounces of silver to equal the value of 1 ounce of gold. But since then, silver has been outperforming gold, and that's what causes this to fall. And we've gone from 122 all the way to 92. This is a big percentage move on the part of silver catching up with gold. So getting into the news, virus surge and new China tensions could spark a 20 to 30% market meltdown. Now, I believe that the market meltdown really needs to be something more like 70% to get us into reasonable territories for the markets. Probably even more than that because of the contraction of GDP, the size of the market compared to the economy. We really need to get back to fair values on stocks, like an 80 to 90% crash at this point. However, 20 to 30% is enough to scare the Fed into action. And when they start doing a bunch of stimulus and what they call asset purchases, because remember, in order to get currency into circulation, the Fed counterfeits it into existence and then they buy something with it. What they buy is usually from a big brokerage house, and that puts it into the markets basically. But 20 to 30% should scare them into creating lots of currency and manipulating us into a even more warped economy with even greater bubbles than we currently have. And it'll turn this melt down into a melt up, where the markets are going up, even though the valuations of the PE ratios, they're going to be going insane. The stocks will be a bad bet one day. Right now, people that are in stocks have done pretty well because they've front-run the Fed. They saw the Fed creating currency. They all jumped into the market. One day reality will catch up with everybody. We'll see how long that takes. But when it does, it's going to be horrific at this point because of how warped everything is. If they had not blown the currency supply into massive bubbles, if Ben Bernanke hadn't done what he did during the bailouts from the QE 1, 2, and 3, if they hadn't pushed the markets into these insane, back into hyper bubbles, if they hadn't pushed real estate back into hyper bubbles, maybe we'd be able to get through this pandemic without the carnage that you're going to see. But I am seriously worried about the stability of the global financial system. I'm not sure how well the monetary system will be able to hold up during this. There is no alternative. The S&P, Standard & Poor's, says that governments must spend to support coronavirus-hit economies. And this just goes on and on. Here we have the Fed opens a $600 billion Main Street program to colleges and hospitals and other nonprofits. Now, $600 billion, that doesn't sound like much anymore, does it? I mean, we always talk about trillions, but got to remember, this is 0.6 trillion. And so it is significant when you talk about a greater than $4 trillion spending this year. And we're not done yet. But before we get to the increase in spending, post-pandemic world will be a frightening mix of financial bubbles and massive debt. This is a pretty good article. It is from Australia, though, so he's writing it from an Australian perspective, but really, this applies to the entire world. We are going to see this super warp. I mean, the Fed warps, all central banks warp their economies when they do any currency creation. Wherever the currency is spent first is driven up into bubbles, and it comes at the expense of the rest of the economy. And so they're stealing from one part of the economy to make a gift of it to the others. I've got some videos coming out that will show this in much greater depth. But when you have massive, we're at the end of the pandemic, we're going to be left with massive, massive debt and a whole bunch of bubbles that are popping and so on. So it's going to be the strangest thing you've ever seen. I don't believe that anybody has ever experienced anything like what we're going to go through, and nobody has experienced anything even near it in our lifetimes. Jamie Dimon, the CEO of JP Morgan Chase, he's warning for the U.S. economy and that nobody knows what comes next. And in this article, he says it's a waste of time even trying to figure it out. He says it's like staring into a black hole, basically. So he's gotten much more pessimistic on the outcome of this. So we're probably getting near the end of this dead cat bounce before the crash continues. CEO of major Asian bank says it's a big challenge is looming for the global economy. And later on, the thing I liked about this article is later on, it's got Singapore's economic slowdown. So you know how I love charts. And this is the second quarter contraction that Singapore has had. But, and this is bad. But it's only going to get worse. We're nowhere near the end of, we're just, we're probably 25% the way through this crash, and maybe even less than that, maybe 10%. This could be bad. I'm getting ready, actually, for the possibility of a total monetary system collapse. Now, that may never happen. It's a tail risk. But that's a tail risk where people can actually die. That has food shortages and the gas stops coming out of the pump. And I live at the top of a skyscraper in Puerto Rico where they have enough problems with the power already. But if the monetary system breaks down, then after a while, the power stops and you have to pump water up to my level. And so I'd have all of these floors, and it's a long way down to the bottom here, to bring water up. So, I'm right now looking at land up in the mountains. But this is the deflation. You know, I've been talking about indeflation, inflation and deflation simultaneously. And I'm seeing food go up at the supermarket where I live. I don't know how it is where you live, but beef prices are up significantly, and many other prices have risen quite significantly. But New York City landlords slash prices on a third of rentals as New Yorkers flee, and they're fleeing from the city to the suburbs. And here is a map of some of the fall in prices, the areas that are hit the hardest. And then gasoline. This is a gasoline and diesel fuel update. Actually, I probably should refresh this because I did this last week. Well, this is close enough. You can just see this downward trend from mid last year. This is a 1-year chart, basically. And that is deflation. And so is the real estate. The real estate was in a gigantic bubble, though. But this will probably continue for a while until the Fed and the other central banks come to even more of the rescue. There is no end in sight. Congress confronts new virus crisis rescue package. This article, Fiscal Cliff, threatens fragile U.S. recovery. And we're just not going to see this. It's not going to be a recovery. We're going to flatten off at a very low level of economic activity for quite a while. It's not going to come charging back. But here it says that there's another round of stimulus, and that stimulus, Donald Trump has insisted that it shouldn't exceed $1 trillion. But House Democrats have already approved a $3.5 trillion package. So we're talking about some major currency creation coming our way. And when this pandemic started, I said that this isn't, this CARES package that they passed right away, that is by no means the end, that this is going to get a lot worse. And so they passed $2 trillion. Now there's another 3.5, so we're up to 5.5 trillion on top of the deficit spending that they were already planning, which was going to be like $1.5 trillion or so. And so, I mean, they could end up. This is nowhere near done. You're going to see this just continue. I am hoping that we aren't in the middle of witnessing the demise of the monetary system as it stands right now. But one of the things that I identified when I was writing my book, I started looking for cycles and patterns that repeat. And I put every single crisis that I could say, every stock market crash, set of bank runs, every kind of crisis that I could find into a spreadsheet, looking for something that had a sort of a regularity about it. And what I found just leapt out at me. It was that the world has a brand new monetary system every 20 to 30 years or so. And now we're way, way overdue for the next monetary system. And the current monetary system is the worst designed out of all the monetary systems. But we've had 4 in the past century. Gold has surged due to pandemic and could keep going. Here's what to know about investing now. This was one of the stories. And what I found very entertaining is you get down into the middle of the story and they're interviewing somebody named Albert Cheng. And he says that typically financial advisors recommend a gold allocation of 1 to 5%. And, they might be doing that on the average right now. But for the from the year 2000 to 2010 or so, they weren't recommending any. You should stay away from gold. Gold is death. It's been going down for 20 years. And then it set these brand new highs in 2011, and they started recommending a little. Well, guess what? Back in the 70s, they didn't recommend any, and gold went up 24 times its price. That means if you put 10% into gold and you lost the other 90, you lost 90% of your portfolio, you would have been 2.4 times richer on just the 10%. If you were a European, Americans could not buy gold when we ended the Bretton Woods system in 1971. It wasn't until the first day of 75 that Americans could buy gold. But when that gold bull market started after Nixon took us off of the Bretton Woods system on August 15th of 71, gold went up 24 times, silver went up 36 times. So if you had had 100% of your assets in gold, you would have been 24 times richer, not 2.4. And that is the reason that for a long time, I used to tell people, I'm fully diversified. I've got both gold and silver. Well, now I've got gold, silver, cryptos, and a few stocks of some silver exploration companies. Those are highly risky. That's my gambling currency. I don't recommend anything. I never recommend anything except to learn as much as you can about what's going on with the financial system and your own financial education. So, but he does say that it could shift higher from 5 to 15%. And I've seen studies that if you go from 1970 until today, which includes the enormous bear market where gold went from $850 to $250 from 1980 all the way to the year 2000, even including that bear market, a 35% gold allocation to stocks, no bonds whatsoever in your portfolio. All the professionals recommend bonds for stability and hedging. But when you do gold, that is the best risk-reward ratio. But when you limit it to just the secular bull markets of precious metals, and you can measure these by measuring them against the stock market and against the growth of the currency supply, against a whole bunch of different things. And you can identify when they were fundamentally undervalued and started their secular bull market. And this pullback that we've been in since 2011, I realize that's a long time, and it's been a very grueling thing to get through. But we are now on our way out of it, and the second leg up of this secular bull market with a cyclical bear market in the middle. That's what we've had. Moving on. Citi says it's only a matter of time before gold hits a record, and they are right. One of the things that I said when the pandemic started is that just when everybody wants precious metals, there's going to be less supply. And one of the things I said is during this pandemic, they're going to have to close mines because you can't send a bunch of guys down into this hole working in close proximity with each other when they've got this virus. And so Pan America has suspended their operation of their silver mines in Peru. So 2 of their mines are temporarily suspended. Silver surpassed $20 for the first time since 2016, and it'll go much higher. But now that is on silver futures contracts. That's not spot silver. So what you want is spot physical silver as far as prices. So this is the speculation of where it's going to go. And I haven't read the whole article, so I don't know which contract it is, because there's always contracts that go forward different months. Zimbabwe steps closer to hyperinflation with only 737.3 annual rate of inflation right now. So they don't consider that hyperinflation, which is somewhat insane. The monthly inflation rate rose in May to 31.7 from 15.1. So the inflation rate doubled in May. And what I find so comical about this is, in mid-November of 2008, their inflation rate hit 89.7 sextillion%. I've shown you these before. Here's a $1 Zimbabwe note, and this is a 2007. And here's a $100 trillion Zimbabwe note from 2008. And the thing is that when Rhodesia became Zimbabwe in 1980, the Zim dollar was worth more than the U.S. dollar. It took about $1.52 or $1.62 U.S. to buy one Zim dollar. And then by 2006, they had to lop off 3 zeros and come out with a new Zim dollar. So basically, you could take 1,000 of the new, if you took in 1,000 of the old Zim dollars to the bank and you exchanged it, you got one that said 1 on it, but that 1 had the same purchasing power as the previous 1,000, so they lopped off 3 zeros. Then in 2008, they lopped off 10 zeros, so now that's the third Zim dollar. And then in 2009, they lopped off 12 zeros, and so that's the fourth Zim dollar. And what the total inflation is that when you add all of this together, it's 10 trillion of the final Zim dollars had the same purchasing power as 1 of the original. 10 trillion. Life is sort of a series of bad jokes, just one after another, and they just don't learn. Now, what I find interesting in that article on Bloomberg is at the very end of it, it says the central bank banned bulk payments on mobile money platforms, which authorities blame for undermining the currency. No, it wasn't that they printed too much. It was people trying to use things like Bitcoin and stuff. That's what caused the hyperinflation. So this is a great article, definitely worth a read. All of Mike Shedlock's articles are fairly short, so they're a very easy read. But Judy Shelton, who is a gold advocate, may soon be on the Federal Reserve Board of Directors. And here she wrote back in 2008, if capitalism depends on designating a person of godlike abilities to manage demand and supply for all forms of money and credit, currency, demand deposits, money market funds, repurchase agreements, equities, mortgages, corporate debt, we are as doomed as those wretched citizens who relied on central planning for their economic salvation. Now, she's talking about the USSR and Mao's China and Zimbabwe. It's time to take on the task of establishing a new foundation for international economic relations and financial relations, one dedicated to open markets and based on monetary integrity. That's how a gold standard works. We need to fix the money, literally. Well, bringing back a gold standard changes the currency back to money, basically. However, I'm on record for saying gold standards suck. It's better to use real gold. A gold standard is some representation of gold. And then, getting toward the end here, this article is definitely worth a read if it's a little bit more technical, but it shows that all of these, whenever you hear that a gold standard doesn't work or a gold standard limits us because of this or there's not enough gold, that is a bunch of baloney. It has nothing to do with it. Anybody that says that does not know anything about economics. They're economically ignorant if they say that there's not enough gold or that a gold standard somehow constrains economic growth. What it constrains is government spending. That's what it constrains. And so that civilized relic. Now, John Maynard Keynes called gold a barbarous relic at one time. So the article is that civilized relic, a monetary system as good as gold. And gold, it turns out, is not a perfect system, but it's the best one that the world has ever known. And now we're at the meme, and I'm just going to let you sit with this one. You can read it. I have no comment. I want to thank you very much for watching. We'll see you next time.